Great to see a wide attendance here tonight. Glad we are actually having people come back after the first week. I didn't chase anyone away. Always a good sign. So today we're going to be getting into talking a little bit more about the income tax side of the VITA program. And that's really taking a look and understanding what we have in terms of our activities here with income. And I'm going to go ahead and share our screen here and make sure that can come through well on the slideshow. It'll take just a second for us to go ahead and get that coming through. And let me make sure that we can go ahead and have everyone see the screen appropriately. Okay, everyone able to see the slides all right? Okay, wonderful. So I wanted to just take some time and go through and talk a little bit more about the income tax side of things, how we're going to go ahead and take a look at taxable income. The first week was spent predominantly understanding the concepts of dependency and filing status. So really had a couple more issues or questions that we had to resolve as we went through to try and understand exactly how we want the return to be prepared. Fortunately, the session this week is going to be based more predominantly on our income items and talking about what it's going to be shown on the return and then how we actually get that into our tax program to make sure everything's looking as complete as possible. So I'm going to go through a couple of those areas this evening. So one of the things we're going to talk about are what are some prime examples of taxable income. First and foremost, we're going to be dealing with areas of wages and salaries, bonus, commission. Effectively, what we look at is W-2 income, and we'll talk about wage activity and how we enter those in a little bit. Other examples would be alimony. So if an individual has gone through a divorce and are receiving alimony payments, those have traditionally been taxable. We've had a bit of a change in the past few years. So depending if they've had a recent divorce, alimony may not be taxable. But if it had been taxable in the past, it probably will remain taxable unless there's a significant modification to alimony. So if an individual has had alimony income in the past, and we don't see it this year, we may just want to ask that question to the taxpayer to make sure, did they receive any alimony or are there any changes in their alimony structure? A couple other things we'll be talking about are things like annuities and retirement activity. We'll also be touching on business income today, which would be an area where an individual actually has income from self-employment. We'll talk about how to deal with those. At the end of the session today, we'll talk about what type of forgiven debt will be in scope within VITA. Go through areas of interest and dividend shortly after the wages. We'll talk about gains from the sale of property. We'll also talk at the end of the session about gambling winnings. And again, spending a lot more time on the IRA distribution, talk a little bit about our other income, such as jury duty fees. I'll cover military pay a lot more in our fourth session, which is really kind of our wrap up with state and local, and then also a couple other more advanced issues. The non-employee compensation, again, will be wrapped up within our self-employment activity. A couple other things we'll take a look at. Rents are taxable income. However, rents are actually out of scope for our VITA program, just because there's a lot more complexity there. I don't think we really take a look at a lot of rental income here in the VITA program, but just to let you know, that would be out of scope for our purposes. I will mention about Social Security and the taxability, what to do when people bring in their documents, or if we have questions about taxability, we can certainly walk through that. Typically, we don't see the next two items that often, taxable scholarships and grants. Those are ones that are traditionally going to be considered non-taxable, mainly because of the fact that when they get a scholarship, it would be used for educational purposes and not for compensation, not like a teaching assistant or things like that in this area. Tips and gratuities are predominantly followed through on the W-2. So those are traditionally covered in that environment. I do have unemployment compensation bolded and highlighted here just at the very bottom to remind people that unemployment compensation is a taxable benefit. So if you're getting paid for not working because you're looking for employment, that is considered taxable activity and is subject to federal income tax. Not subject to state income tax, but is subject to federal. And there's one issue that we had seen if you've been preparing returns for the past couple of years in 2020. There was a very late change that had allowed unemployment compensation to have a portion of that become non-taxable. Depending on how much they had earned, that portion would not be taxed on the return. It usually, that actually happened after a lot of returns were already filed for VITA, became a retroactive change. The government had to fix those. That went away for last year, not in the tax code this year. So again, all unemployment will be taxed in full. Other areas that we can take a look at that are not taxable, however, again, they'll be found on D2 of your 4012, would be things like child support, damages for physical injury. So if people have a payment for a sickness or injury, or if they've been sued or been a plaintiff in a lawsuit and they're getting money back on physical injury, those are not taxable. Traditionally, what we take a look at for tax laws, if you're getting paid because you cannot work due to injury or illness or sickness, not taxable income. If you're getting paid to work or getting paid because you can't find work, that's taxable income. So generally how we take a look at those differences there. Areas like in child support, not taxable. We usually get a question each year. Someone comes in, I've inherited money or had been gifted some money. How much tax do I need to pay on that? Good news is there's no tax at all on gifts and inheritance. So we don't have to worry about that coming into play. Usually insurance proceeds are not going to be taxable either. However, just one quick caution we have as we go through the process is making sure that we are not taking a look at getting an insurance reimbursement for things like healthcare. As we talk about our itemized deductions next week, we have to reduce the amount of our total medical expenses by any insurance proceeds received. They're going to be tax-free, but we also have to reduce the expenses. Quick question came up about inheritances being taxed at the state level. They are not taxed at the state level either. So gifts and inheritance is not taxable at the federal, state, or local levels for our recipients. There may be some inheritance tax. If you've heard about that in Pennsylvania, that's actually applied on the estate itself, not on the recipient of the funds. We kind of mentioned a couple things may be exempt, including tax-free securities. We'll talk a little bit about where interest might be coming from. Typically, that would be if you have any municipal bonds or any other type of investment that's not taxable at the federal level. There's also a corollary where federal income can be taxed, but not at the state level, and vice versa. Again, we talk about kind of sickness, injury, supplemental security income, the SSI, certain veterans benefits due to disability are not taxable at the federal level. And again, workers' compensation based on the fact that they are payments for the inability to work would not be taxable. Now, where are these items going to fall? Once we get them entered into TaxSlayer, they're actually going to automatically go on the return and be presented for purposes of the tax return. Couple changes this year, as we mentioned. Form 1040 is going to have a few more lines on page 1, but really they're going to be found the exact same place they have been in years past. So the wage income, again, coming from the W-2 will be on line 1A. Interest income, which we'll talk about in just a little bit, will be found on 2B. Dividend income on 3B. The IRA distributions themselves will be on 4B if they're coming from a pension or annuity. They're also going to come off the 1099-R. They're going to be separated again as they have in the past. So we'll see IRAs on line 4B, and our retirement distributions from pension annuity on 5B. Social Security, we're going to see the gross amount on 6A and the taxable amount on 6B. Fortunately, we do not need to do any calculation for Social Security. The system will automatically go ahead and do the calculations. Social Security can be taxed anywhere from 0% up to 85% of our gross benefit, but the tax system will go ahead and figure out how much will be taxable. Based on a couple other factors, including how much other income the taxpayer may have, that even includes any items from non-taxable sources, such as tax-exempt interest. A couple things on Schedule 1, which is really our other income, would be things like the alimony received. Again, typically, if we're having an individual pick up alimony income, they've been receiving that probably before 2018. So we should have the information available for us from prior year returns. We just need to put the date of divorce on that line, as well as how much alimony had been received. Unemployment compensation, we mentioned, also taxable for federal purposes, not for state or local. That will also be shown on Schedule 1. In addition, a lot of other areas for other income will be shown on Schedule 1 as well. Now, to highlight just a couple pieces here with our W-2, let me actually see if I can do a couple of my magic wand techniques here. Here we go. All right, so just wanted to point out for those of you who have not seen a W-2 before, this is a traditional W-2 form. Now, the other downside is the W-2 does not have to come in a standard format. It can come in a variety of sizes, variety of information, but it's all going to have the same boxes on the W-2 itself. So just a couple things to point out for us here. Very important that we get the employer identification number down correctly. That's this number up here, which will go ahead and show us what the employer's identification number is. That will actually help trigger the information to populate inside the tax return, also allow the IRS to match that W-2 at the end of the year when they process the returns. Now, good news is if you haven't been part of VITA before, if you enter the employer identification number, that information for the employer will automatically populate if someone else at VITA has already entered that same W-2. So if we have a common one, things like School District of Lancaster or large employers like Lancaster General Hospital, that information will already pre-populate, so it saves you some typing. Other great benefit, if the individual has been in the VITA program before and they elect to have their information carry over, all their prior W-2s and everything else can also carry over as well, so you don't have to re-enter all the data. Just want to point out, though, however, whenever we get a W-2, we should enter the information to try and match the information on the W-2 in the return, which may include just making some modifications here to the addresses. The information may also include taking a look at the address as reported for the taxpayer. Again, for the 1040, we want the address for the 1040 to be that of the current address of the taxpayer. The W-2, we may want to go ahead and make sure that we have the prior address in there. Other pieces of information I just want to point out, the wage activity is going to be coming out of box 1, so we'll make sure that that is entered into TaxSlayer as box 1. Also, the federal income tax, we'll have to enter that as well. TaxSlayer, by default, will try and go ahead and make sure that your Social Security wages and Medicare wages are going to be equal to what you have in box 1. That may not necessarily be the case here in Pennsylvania because we may have some differences between your wages and Social Security and Medicare. So we just want to make sure all these are entered as you see them on the W-2. Now, we do want to take a look at a couple other pieces on the W-2. We don't often see the Social Security tips. However, if you have a taxpayer that's in the food service business or one that has a high amount of tips, they may actually have a lower Medicare wages and tips, and we may see that in Social Security. Again, just enter the W-2 exactly as it's shown. If the taxpayer thinks that the W-2 is incorrect, we actually cannot fix that here at VITA. We're going to have to actually send them back to their employer and have any questions addressed at that point in time. If there is a corrected W-2 coming through, that's fine. We at VITA cannot do that for them. If they come back with what's called a W-2C, which is a corrected W-2, then we can enter that information into the tax return itself. You do want to watch here for box 10, any dependent care benefits for those individuals who are going ahead and having some of their pay taken out pre-tax for child care benefit. That amount needs to be reported on the 1040. It's going to also come in a calculation for the child and dependent care credit that we're going to talk about next week, but we just want to be sure that that is reported as well. A couple other things or anything here in boxes 12A, 12B, 12C, and 12D. These pieces of information will typically flow to other parts of the tax return. So if we see anything in the box 12A or 12B or 12C or 12D, we can enter those codes with the information. It's a pretty simple drop-down box. If we need to add more lines, you can certainly do that. Common ones would be things like a code C for group term life insurance, a code D for 401k contributions, a code E for 403b contributions, and a code W for HSA. You don't have to memorize any of those codes. They're all going to be listed in your 4012. They're also on the back of the W-2 in case you have any questions about what those codes are. For the most part, they're relatively straightforward. We're really not going to have a whole lot of hopefully outlandish ones. If we have any military issues, I'll cover that in session number 4. We do want to double check and see we may have to check a box that's going to show retirement plan. That would be in area 13 here. The information in box 14 actually does not go anywhere on the return. So you don't really need to input that into our tax system simply because it doesn't actually carry automatically to other forms on the TaxSlayer program. At our session number 4, I'll talk a little bit more about our state and local, but just want to remind you that oftentimes the PA wages might be different from that of federal because there might be a couple issues predominantly with retirement contributions or a few other things. So just be sure that when you take a look at state wages, state income tax withheld, local wages, and local income tax, that those are all entered as shown on the W-2. Now, for those of you who have done this before, if you have a difference between your Pennsylvania, your Medicare, and your federal wages, you'll probably get a little diagnostic warning to say, are you sure you entered everything correctly? I'd love to get that thing taken off our VITA system, but unfortunately we can't do that here in PA. So you just have to kind of click through that warning to say, yes, I'm aware that we have a discrepancy between those wages. Okay, just want to see how we're doing so far on wage activity. Any questions anyone's had on W-2s? Okay, looks like we have something coming through in the chat. Okay. So question coming through, we have questions about box 14 and PSERS contribution. So PSERS contributions are going to be predominantly for employees within the public school system. These are contributions made to their retirement account. So in box 14, we actually don't have that information automatically flow anywhere else. We can talk a little bit more about the retirement savers credit next week and how we would handle some of those issues. A lot of that is from a more likely than not, your site coordinator will probably have a way in which they want to handle the PSERS contribution. But that, if you put it in box 14, will not automatically flow anywhere. If you want to enter the W-2 information exactly as you see it, if you don't want to let anything go blank, that's fine. You can still fill out box 14. It just won't automatically flow to any other portion on the 1040. Did that help answer the questions? Okay. The next item I want to take a look at is our interest income. So interest income, you'll notice that because we have a form 1099 INT. So as we go through tonight, I just want to kind of remind everyone that if a client hands you a pack of documents, and hopefully they've already opened them up, otherwise you're going to get a whole lot of mail coming in that they have, probably it'll say on the outside, important tax document, do not throw away. I've had clients that come in, they'll hand me a whole pile of things, some of which will be relevant to the tax prep process, some will be real estate tax bills for the following year, some will want me to fill out their publisher's clearinghouse forms. Typically, we do not do that unless you're going to share the winnings with us. Just kidding, we cannot take any monetary contribution from the taxpayer. But typically, we're going to be looking for their tax documents. Anything that has a 10, a 0, and a 9 in it, we probably need to go ahead and make sure that's entered somewhere on the return. The 1099 series information, the W-2 information is all shared with the government. So the U.S. government's going to know exactly how much was reported to the taxpayer for their salary, their wages, their interest or dividends, their sale proceeds, their Social Security, their retirement benefits. So we want to be sure that we have that information reported on the tax return. Otherwise, we may have an issue down the road that the IRS is going to say we have a mismatch issue. So for the 1099 series here, what you'll see is the INT is actually going to refer to interest income. The predominant ones we're probably going to see here on the 1099 INT will be our interest income in box 1. Generally, we've kind of talked about in the past that we haven't seen this all that often because interest rates have been relatively low, particularly when we're talking about individuals qualifying for the VITA income level. But now that interest rates are rising, we may see a little bit more of interest income. As a reminder, the 1099s will only be issued if there's $10 or more of interest received by the taxpayer. So I've had situations where taxpayers come in and they said, I'm not quite sure what's wrong with my bank. They haven't given me my 1099 INT for the year. I'm pretty sure I get it all the time. I know I have a little bit of interest in the account. And what they may end up doing is bring in their bank statement that shows December, and we'll take a look and it'll say interest paid to date, and it'll say 33 cents. That is fine. We are not obligated to report that information on the return. If the taxpayer would like to, we certainly can get that into the return. Just to let you know, if you put 33 cents in, it's going to round down to 0. So if you really want that interest on your bank account to show up, we have to round that up to $1. It probably will not impact the tax calculation for the taxpayer. But just to let you know, anything under $10 for interest will not be presented to the taxpayer. So box 1, probably the one we'll see most often if they have any savings bond interest. That could be Series E, Series I, that would be shown on box 3. If we just enter the information exactly as it's shown on these forms, it's going to go to the correct locations. Interest income is going to be taxable for federal and state purposes unless we have some state exempt interest. Interest on box 3 will be taxable for federal only. It will not be taxable for state purposes. Just want to point out that there are a couple boxes here we don't often see, but just want to double check to make sure there's no information on those. That includes box 4, which is our federal income tax withheld. Don't see it all the time, but every once in a while we have an individual who is subject to backup withholding and is required to have federal taxes withheld on their investment activity. So that could occur here on the 1099 INT or on the 1099 DIV, which basically stands for dividends. So if a taxpayer has dividends, they're probably coming from one of two ways. Either they have a direct ownership in stock. They might have had what's called a dividend reinvestment plan, where they own shares of stock and they're held directly with the company. So that's one way they can be getting a 1099 DIV. That'll be coming directly from the issuer, usually just a one-page form. The other way they might have that is if they have a managed account or brokerage account, they might get a consolidated 1099 from a broker, which is going to have the 1099 INT, 1099 DIV, and then we'll talk about the 1099B information altogether. So that's entirely fine. No matter how that comes in, the information, again, will be exactly the same. These forms may not look the same, but they're all going to have the same information that we need to help prepare the return. So when we take a look at dividends, we're going to take a look at ordinary dividends. That's the amount of gross dividends that the taxpayer has received. There's another box that's going to be important called qualified dividends. That's box 1B. The qualified dividends are actually a tremendous benefit for the taxpayer. If they've held on to the security long enough, the dividends are going to be considered qualified. And if the qualified dividends are received, that could mean that we have a much lower tax rate than the traditional itemized or the graduated tax rates. So the basic tax rate we have here in the U.S. is 10%. We don't actually have a zero rate. It's starting at 10% once you're actually above any dollar of taxable income. But the qualified dividend allows us to have that tax potentially at a 0% rate. So we'll see that special tax rate for qualified dividends and then also for long-term capital gains. So the only reason I just want to mention that to you, two things. One is to be sure we get that information entered in on the return. And secondly, if you take a look at a return and you take a look and you realize the tax is not at least 10% of the taxable income, it doesn't mean the system's not doing its job correctly. In fact, it's probably doing the calculation to give you a special rate for qualified dividends and long-term capital gains. I've had a couple clients where that's their only source of income, and they've actually had taxable income, but no taxes due. So not a bad situation for them at a federal level. A couple other things we may see if it's a more I don't want to say complex, but if you have investments in, say, a mutual fund or other type of investment account, we may see some activity here on line 2A, which are capital gain distributions. We may see some non-dividend distributions. We'll talk a little bit about foreign tax paid next week. As long as all their foreign taxes are being withheld on the 1099 DIV, we can actually take that on the federal return as a credit. Most of the other ones are probably not going to be overly applicable. However, if you do run to a unique situation, by all means, go ahead and be sure that we have the time to address those questions. Be sure you run those by the site coordinator. And if anything happens, we can certainly go ahead and take care of those at a higher level as well. All right. So taking a look at the next series that we have in the 1099 would be our 1099G, which is going to stand for government payments. The predominant one we're going to have here would be our unemployment compensation. So again, what we'll do is we just enter this information into our tax layer system. Good news is once you get that payer's federal identification number in there, we should have someone that's already put in the PA, the Commonwealth of PA information. My tax software does not automatically pre-populate. So in the years where we had many people while collecting unemployment due to the pandemic, I was very familiar with putting in the 651 Bola Street address up in Harrisburg. Fortunately, you do not need to do that. The first person who does the first return in VITA will enter that information, then it should copy over for everyone else. Just to give you a couple points, the unemployment compensation will be in box 1, and that will be taxable in full for federal purposes. Again, not taxable for state or local, but it will be taxable in full for federal. Hopefully, the individual had elected to have unemployment since they know it's taxable, hopefully have the federal taxes withheld. That would show up in box 4. So again, we're just going to go ahead and put these pieces of information in the return exactly as they're shown. All right, how are we feeling with the 1099 series so far? Any questions arising? All right, we'll move over to the next area. And so typically, depending on what site you're at, you might see a lot of W-2s. If you're at other areas, you may see absolutely none. And if you're going to see no W-2s, you're probably going to see the following form, which is the form SSA 1099, the Social Security Benefit Statement. Now, I probably should have gone ahead and put this in full and glorious color for you, because the main information we need off the SSA 1099 is actually this shaded box, box number 5. Fortunately, The government's issuing it. The government's form looks exactly the same every time it is issued. So the predominant information we're looking for when you enter the Social Security information in, we really just need to understand, is it going to be the taxpayer or the spouse with their Social Security number? And then we can enter the net benefits coming out of box 5. Generally, other information might be things in box 3, which would be their Medicare withheld out of their payments. So we can go ahead and enter that information in if they can qualify for itemized deductions. We do want to double check. It doesn't happen all the time, but some individuals actually do have federal income tax withheld on their Social Security benefits. That would be shown here in box number 6. So again, the input area is relatively straightforward for SSA as long as you get the information down for the taxpayer or spouse. Again, what's going to be found in box 3 is going to be the Medicare portions that we'll have. For those of you who are not aware, we are right now in the middle of Medicare enrollment period. If you haven't turned the TV on since the election ads have been running, they've all now been converted to Medicare election enrollment ads. So apparently there's plenty available out there on TV spots currently. So that information can be used for purposes of deductibility for medical expenses if they qualify. The other issue I just want to mention about Social Security benefits, just in case you run into a situation of lump sum distributions. The tax layer system can handle that fairly well. The lump sum distribution election is actually now found on the front page of the 1040. If you do that, there will be a checkbox that automatically populates, so you don't really need to worry about it. It's just a notification of the IRS, part of their flagging system to understand how that's going to be processed. What a lump sum distribution would be is if you have an individual who's applied for Social Security benefits but did not receive them in prior years, and all of a sudden a determination's been made that they were entitled to receive those benefits, all those benefits are reportable in the year in which they're received. So if for the first year that they actually get them are for 2022, but they actually applied for 21 and 2020, we can actually make an election to treat them as if they were earned in 2021 and 2020, rather than all in 2022. It's a technique to smooth out that tax burden a little bit. Those may take a little bit more time to walk through, so you don't have to finish that return immediately, but we do have that opportunity if someone is looking at a lump sum Social Security activity. All right, and as I mentioned before, Social Security is not going to be taxable in full, but we do need to have that information. A couple of times we probably have had clients come in and they say, you ask, do you have your Social Security statement? Well, I don't need it because I'm over the age of 75. I don't pay taxes anymore. Well, maybe, maybe not. We still need to get that SSA 1099 in each year because guess what? The government's already going to get a copy of that. It's beneficial for us to have that into the return just to go through the calculations and make sure that we're reporting all the income effectively. So we do want to be sure that we get that even if they believe that they are not going to be taxed. Now, taking a look at our next area, this one's a little bit more involved, and we're going to spend a little bit more time on the 1099-R system. So I may refer back to this 1099-R a couple times as we go through some information. So we're going to talk a little bit more about what the form is, what information are we going to be finding here, and then there are some things that we need to take a little bit further look at the whole process with 1099-Rs. So 1099-R is going to be a distribution, effectively say a distribution from a retirement account. So we have to go all the way down to find the R here. So it's effectively a 1099 retirement distribution. So again, we want to be sure that we're entering the employer identification number, identifying whether this belongs to the taxpayer or the spouse, and entering all the information. So a couple key elements that we're going to have here is you're going to see box 1 is gross distribution. That's going to be how much money has been paid out to the individual. Now, that might not be exactly what they received because if they had any federal tax withheld here in box 4, that amount is not going to be given to them in cash. That amount's actually withheld and provided to the government. So we do want to take a look at box 1. That's going to be the gross distribution. That's what's going to trigger the rest of the information on the 1099-R. Another important piece is box 2A, which is the taxable amount. So oftentimes you may see box 1 and box 2A being identical. That's perfectly fine. If box 1 has an amount and box 2A is blank, we'll tell you what to do in that one. If box 2A is different from box 1, that may be fine as well. Typically, we may see that there's some element here in box 5, which would be the the employee contribution to a retirement account. So that part is going to be a return of capital that will not be taxable to the employee. So what we see is we're going to enter the information on box 1. We're going to enter what we see in 2A unless there is a bit of an issue, which I'll talk about a little bit in a second here. Federal income tax withheld in box 4. So it could be appropriate if we have individuals. Usually the easiest area for someone who does not have wage income to have withholding would be off a 1099-R. It's the easiest one to get set up. You can pick what percentage you want when you talk to your broker, particularly if you have required minimum distributions. Distribution code. Once you get down here to box 7, this is going to be important for us to identify what the distribution code is on the 1099-R. And then right next to it's going to be a little toggle switch to say, is this an IRA, SEP, or simple? What this will do, 2 things. One, it'll show where that information is going to be reported on the front page of the 1040. And 2, whether or not they're eligible for certain penalty exemptions if we're going to see an unfortunate code. And for our purposes here, we're showing the one code you really do not want to see when you're preparing a return. That's going to be code 1. So these codes I have listed here in your slide activity. That's actually also going to be found on D43 of your 4012. These are the more common ones we're probably going to see within VITA. The one we really don't want to see is going to be that code 1. That's an early distribution. No known exception applies for penalty purposes. In most cases, that individual's under 59.5. And I'll talk about where that comes from and what we get to do with that as we move forward. For state and local purposes, that is also going to be taxable. So it's going to be taxable for federal purposes. It's also going to be taxable for state and local. If we have a code 2, it means it's also an early distribution, but not subject to penalty. It means that there's some sort of exception that applies, and I'll talk a little bit more about the penalties in a little bit. For state purposes, that's also potentially going to be taxable. Now we can take a little bit of a look at cost recovery and how that'll come into play. Code 3 is a distribution on account of disability that is taxable for federal purposes, no penalty involved, but not taxable for state. Same thing if you have an inherited retirement account. It's going to be taxable for federal purposes, but doesn't matter if the recipient is under 59.5. It is not subject to an additional 10% penalty, also not taxable. I'll talk about these red ones in just a little bit, code 6 and code W. They're technically outside of scope of VITA, but just want to kind of give you an idea of what those actually mean and how they can potentially have a bit of an issue for PA purposes, not for income tax, but more so on the rent rebate or tax forgiveness. The one code we want to see comes all the way down here. This is a code 7. This is a normal distribution, means that the individual has met normal retirement age. All the money coming out that's going to be shown in box 2A is going to be taxable to them in full, but no penalty. Pennsylvania, if you may have read recently, Lancaster has been rated one of the best places to retire in the entire country. I imagine it's because, again, we have great farmland, fresh air. You get to have chow chow if you've never had that before, some local Lancaster County delicacies. You get free tax preparation from VITA. But the benefit, we don't tax Social Security and retirement distributions here in PA. So no tax on those as long as you meet the qualifying retirement rules. Another code that we may see is a code G. This is going to be a direct rollover of a distribution from a plan to another plan provider. So that means that none of the money will be taxable. It's just going to be deferred until a later period of time when it's withdrawn. That will not be taxable for state either. Another rollover that could occur is if you have a Roth account, that's going to have a code H. Again, you don't need to memorize any of these codes. They're just going to be showing up on box 7. Like I said, they do have a whole list in D43, or most 1099Rs. You can turn it over and take a look at the code if you're not quite sure what that is. For the Roth, we pretty much have 2 that we can work with. One is a rollover for Roth, or the second is going to be a code Q, which is a qualified distribution from a Roth. Both those are going to be fairly easy to take care of. One other little area that we have is a code 7D, which I'll talk about. So this is one where we actually combine a letter and a number. We can actually put multiple codes down. This is actually going to be one that has a little bit of a unique approach because this is actually going to be taxable on state as interest. So I'm going to go and give you a quick overview of what that means. So code 7D is actually what we call a non-retirement annuity contract. It's effectively a plan you generally purchase from a life insurance company, structured payments. These are effectively like a investment account. You give them a sum of money and they will pay you back that money over a period of time, non-retirement annuities. So if there is an amount in 2A, which typically would happen with these annuity contracts, that amount is going to be taxable for federal purposes as a 1099-R distribution. For PA purposes, the code 7D is going to be taxable for PA as interest income. So it actually represents an investment product. So that's why that taxable amount is going to actually move from a retirement distribution, again, not taxable in PA, to a taxable interest portion. Same thing if we have a code F. I don't think we really see those all that often here within VITA, but that would be if you bought a charitable gift annuity from a qualified organization. If there's anything in box 2A that's also taxable for PA's interest income. As I mentioned, a distribution code 4 before represents that you're receiving a payment as a beneficiary. There's no early penalty because even if you're under 59.5, it's on account of death. That is also not taxable for PA or local taxes. The income would be, so that's going to be subject to tax, but not for penalty purposes. A couple other things, as I mentioned, the code 6 and the code W. Technically outside of scope of VITA, but they're really not that complex to deal with. So if you have questions about these, or you may have them on your own return, we can certainly take a look and see how those are going through. The code 6 is going to represent a tax-free exchange of a life insurance contract or annuity or long-term care insurance. Typically, it means if you're moving from one account to another, you'll get a distribution code 6. It is not taxable at all for federal purposes or state purposes. However, that can present a problem when we talk about the PA tax forgiveness and the PA rent rebate. So PA is going to require that those get added back in as income, even though they're really not income. They can present a problem for the SP and the PA 1000. Same thing for the distribution code W. Those are also going to be tax-free for federal, state, and local purposes. That is essentially paying for a long-term care insurance outside or with your money out of a retirement account. Okay, and a question about the 7D. I believe it does automatically flow to the state. We are going to take a look at that during review. The site coordinators that I've been talking to have said it has been working pretty smoothly here as long as you make sure it's entered as 7D and not D7. So as long as it's in a 7D, it should be in pretty good shape to move forward. Okay. So again, 6 and W really probably won't have a whole lot of issues as we go through, but just want to be sure we have those appropriately detailed for you. Okay, let me make sure. Oh. Okay. Okay, let me just take a look at a couple other quick things here. So typically what we're going to take a look at here are the pensions and annuities are going to be any of our distributions from a 401k, a 403b, or government 457 plan. So these are effectively going to be taxable in full to recipients as long as we did not have any after-tax contributions made. I'll talk about how that'll work. Hopefully we don't have any of those. Not a great situation to be in. We're going to go ahead and report that on the 1099-R. That'll automatically flow to the correct portion on the Form 1040. One thing I wanted to mention here in the middle of this slide is really the exclusion for insurance premiums for retired public safety officers or PSOs. A little bit more information in your Pub 4012 on N-6. So a public safety officer is any retired law enforcement officer, a firefighter, a chaplain, member of a rescue squad, ambulance crew, who is using part of their retirement distribution to help pay for insurance. So that is any type of health insurance or accident insurance or long-term care premiums. So if they're using some of their insurance premiums out of their retirement distribution, they can actually get a reduction of their taxable amount. The smaller of either the premiums paid or $3,000, obviously whichever one's smaller. And we have some instructions on the N6 of how to do that, of how to enter that for a PSO. When you prepare the return, you'll actually see that there's a little indication on the 1040 that says PSO, and the taxable amount of distribution will be reduced by that smaller of the premium or $3,000. Now, as I mentioned, we may see some differences here. What happens with box 2A? What happens if there's an amount there? If there's an amount there, we're simply going to go ahead and put that amount in. If there's nothing in box 2A, we're going to go ahead and try and figure out what we can do with that. So like I said, if there is an amount sitting in box 2A, we're going to go ahead and just report that as shown. We're going to go ahead and enter that in the 1099 input screen. That amount will automatically flow to line 4B or 5B, depending if we check that IRA box or not. If there is not anything reported in box 2A, now typically it may happen you get a 1099-R, box 1's going to have an amount in, either box 2A is blank or it may say unknown. One thing we have to basically take a look at, if this is a normal retirement distribution, no problem. The distribution is probably going to be fully taxable. So, but what we have to do is we have to ask the taxpayer a question if we see it says unknown. And the question is something along these lines. Have you made a contribution to your retirement plan with after-tax dollars? Now, again, the look you're probably going to get back is one of somewhere between confusion, bewilderment. They don't know if you're speaking English. That is fine, because the answer should hopefully be no. Hopefully, they did not have the opportunity to put after-tax dollars into a retirement contribution account. One, is very hard to do so. Two, it makes that return impossible for us to do within VITA. So if they come back and they say, no, I've actually put some after-tax dollars into my retirement account, then we have a little bit of an issue that we cannot prepare the return within the VITA program. We have to go ahead and give them their information back and send them off to a qualified preparer. Question coming in about the PSOs. Premium for health or long-term insurance report on the 1099, basically a question for the taxpayer. So sometimes what you may have when you take a look at those distribution reports coming in, it may say that here's the amount that we have paid on your behalf for medical premium. So if they're using a plan directly from the provider, it may give a indication how much was paid, but it's not going to be shown on the 1099-R. It's something we're going to have to either ask the taxpayer, or they may be accompanying a letter or some sort of newsletter or something along those lines that'll tell us how much that they have. We'll just have to confirm that. One of the other issues we have about distributions will also be on the Roth IRA accounts. So again, hopefully the Roth, we have just one of two options coming through. Either we're going to have a tax-free rollover for Roth, or we're going to get the code Q for a Roth IRA, meaning that is a qualified distribution. Roth accounts are really unique because if you have made a contribution to the account and you wait 5 years from the contribution, and you take that distribution out and you're after 59 and a half or due to disability or a beneficiary of an estate or paying first-time home buyer amounts, everything is tax-free. Your contributions always are going to come back tax-free no matter whether you have any earnings or not. And the earnings are going to be tax-free if you meet those two conditions. If you do not meet those two tests, if it has not been more than 5 years since the first contribution was made, or they're not 59 and a half, it's not due to disability, there's no first-time home buyer, then we may have a partially taxable distribution. And unfortunately, in that case, we then have to go ahead and probably refer the taxpayer out, or at least have a conversation to determine where we go with the return itself. Now, another scenario that could occur would be if we have a partially taxable pension annuity. So this really comes into play whenever we have an investment in contract. And I've seen these a little bit more within government retirement programs. So generally, the way you're going to see this information is if you have a 1099-R coming in the first year that payments are made, and there's an amount sitting in box 9B. And I will kind of quickly go back to that area here on slide 10 and show you down here is an area called total employee contributions. So total employee contributions would be reported in the first year in which an individual is actually receiving a distribution. So what that means is that they actually have some money that they put into their retirement account, which means they're going to get part of that back tax-free. And we can go through a couple different calculations to determine how much or that will be tax-free or how we allocate that over the contract period. And the main way we're going to do that is called the simplified method. Simplified method actually has to be used under one of the following two circumstances. One is they actually started after July 1st, 1986, and the simplified method was used before. Or more appropriately, probably the second one here, we started that annuity after November 16th, 1996, and both the following apply. It's actually paid from a employee plan, a qualified employee annuity, or a tax shelter plan, basically a 403B, and the annuity start date, the recipient's under age 75, or the guaranteed years is fewer than 5. So typically, that's what we're going to see if we have to do the simplified method. If we can't do that, if we can't use the simplified method, then we have to use a general rule, a lot more complex. That would be in Pub 939, just to let you know where that would be in case we have to have any additional information. But once we actually determine the simplified method can be used, we simply need a couple things. One is take a look at the prior 1040 if we've actually done the simplified method in the prior year. Now, we had a conversation this morning about our traditional print program does not actually show the simplified method calculation form. So one of the things we take a look at are, I know one site was actually writing down how many months they had left, how much of the contract they've used already. However, I want to give you another technique here too. So if you've been preparing returns and use that VITA default position to go ahead and take a look at the screen, the VITA default one is actually going to take out all the other pieces of information you don't really need to give to the client. However, if you take a look at just the federal return print preview is going to give you all of the data inputs. It's going to give you all of the schedules. So if you want to go ahead and take a look, you can either pull open the prior year return and you can actually go in and change your tax year and pull that up if you'd like to. Or if you want to make sure the client has a copy, you can actually go in, print preview the full return, and then take a look at the simplified method worksheet, which should be there. So we need to have the prior year 1040 information if we've been using it on a prior return. If this is for the first year, we're going to need a couple other pieces of information. So we need to know what type of annuity it is to make sure that whether it's a joint or single life annuity, usually the taxpayer is going to know whether or not they're going to get it themselves or whether their spouse is also going to get a portion of it. We need to know the ages of both spouses. And you're thinking, where do I get that? Well, fortunately, as we talked about last week, we're going to get that information as we enter the taxpayer information into the return. So we automatically have both ages of the recipients, so we know which one we're going to use. We just have to determine, are we using joint or single life annuities? Now, the tax layer program will actually pick the correct tables. You can do this manual if you want to double check. And usually we're going to be taking a look at single life annuities or joint. So it's going to be going over the expected life of the annuitant. Now, some annuities may be actually based on a fixed period. We don't really have a lot of those. But if we have a fixed period amount, we just use the total number of months the annuity will be under contract. So let me just give you a quick example of how the simplified method would be used. So here we have Bill Smith, age 65. He's starting to receive a retirement benefit here in 2022 for the first time. It's a joint and survivor annuity. So what we're looking at here is the start date is January 1st, 2022. Benefits are going to be paid over the joint lives of Bill and his wife, Kathy, who's also age 65. Bill has an entire contribution of $31,000. That's what we're going to see in line 9B of the 1099-R. He's not had any distributions before the annuity starting date. He's actually going to be getting here, in this case, a distribution of $1,200 per month. So that means that he's actually going to be receiving for the year a total of $14,400. Kathy's going to get $600 a month upon Bill's death if Bill predeceases Kathy. So what we're taking a look at here, the first question is, should we actually be able to take the simplified method? And the answer is yes, we're meeting those criteria. So what we have, this is the first year the annuity has been taken. It's well after the start date that we had taken a look at on the prior slide. Both annuitants are under the age of 75, so we'd be using the simplified method. And what we'd end up doing here is we would go ahead and take a look. If we wanted to review the tables, we do have some reference links for you in the 4012 and also the 4417. Sorry, I'll have to double check on the other one as well. But we have some reference guides to go ahead and do the simplified calculation. The software will do it. Effectively, if we would take a look at the annuity tables, a joint life when we have two individuals, 65 and 65, would come up with a factor of 310. Which means what happens is we take 31,000 divided by 310 payments. So we'd be able to take $100 per month as a tax exempt distribution. You're going to recover that $31,000 over the next 310 payments. So the system's automatically going to go ahead and do the simplified calculation. We just have to go ahead and start the process with inside tax layer. And we just need to go ahead and keep that moving forward. And understand that we only have 310 months to use it. Once we hit the 310, if they continue to live beyond that, no more deduction, goes back up to full taxability. If they happen to die before the 310 payments are actually used, we can take an itemized deduction for the remaining balance of unrecovered cost on the final income tax return. Hopefully, we don't need to get into that situation too much. Any questions so far on the 1099-Rs for the simplified method? Okay, just want to move on here to early distribution activity. And one of the things we take a look at here, the early distribution from a retirement plan, not a great situation to be in. This is typically where we're going to have a couple issues because we may need a little bit more information from the taxpayer. We may need to go take a look at a couple different things here in terms of getting some more information from the taxpayer to see if we can avoid or eliminate any type of penalty or have a difference in how we report income for state or local purposes. Usually I refer to the code 1 in box 7 as our, not quite sure I'm allowed to use brand names. We normally will call it the Kleenex code, or we'll just call it generic facial tissue code, just so maybe that's what's getting kicked off here of YouTube, that we're using product names without appropriate endorsement, but we'll see what happens. So why do we call it the Kleenex code? Because what happens is a code 1 in box 7 means not only do we have a distribution that's taxable, it's also going to be subject to an automatic 10% penalty for early withdrawal. And one of the things we're going to take a look at is how that comes about. Well, typically where we see an early withdrawal distribution is where we have an employee who separates from service. Either they may have been terminated, they quit, and their employer says, oh, by the way, you have some money sitting in our retirement account here. What would you like to do with it? We have a couple options. So you have a $1,500 balance in your 401k account. Option number 1, you can go ahead and take the cash. And what's going to happen when they talk about taking the cash, you have to sign off a couple forms. You're going to have automatic 20% withholding on the money, but we can give you cash basically almost today. The taxpayer is not going to hear the rest of that conversation other than getting cash today. And oftentimes we have people who go say, yes, I'll take that $1,500. That sounds like a great deal. I will use that for something really, really important in my life, like brand new TVs, or maybe taking a vacation or doing something along those lines. So that's usually where we see the problem occur. Their other options would be to either roll that money over from the former employer to the brand new employer's account, or to roll that money from the former employer to an IRA account. Those other options, those last two, are going to be tax-free and penalty-free. But a lot of people, unfortunately, take that early withdrawal and take the money out of the account. So if that happens, it's going to be an automatic 10% penalty. Unless we want to try and go ahead and reduce that, it's going to be automatic. You do not need to do anything else. The downside, we do have some problems here because for Pennsylvania and local, if a code 1 occurs, they're also going to be considered taxable for Pennsylvania and local purposes. So that would be showing up in the form W-2S. It's going to flow to compensation. For local returns, that's going to be other income. Now, the good news is we can actually have what's called cost recovery. So for Pennsylvania purposes, as we mentioned, Pennsylvania does not tax retirement plans. The reason why they don't tax retirement plans is because no one has gotten a deduction for putting money into a retirement plan. When we take a look at a W-2, we may see that federal wages are going to be less than Medicare. And typically they're going to be less than Medicare because you get a tax deduction for the amount that you put into your retirement account. Not so in Pennsylvania. Pennsylvania will have your contributions for a retirement plan be non-deductible, but then on the back end, they're not going to tax them either. So Pennsylvania is kind of the first originator of the Roth type plan, where we don't get a tax deduction for the money going in, but we don't pay tax on the way out. So what that means is we actually have the ability within Pennsylvania to recover any of our costs. How much did the employee contribute to the retirement plan? Now, you can ask the employee, and they probably have no clue as to how much they put in. So the next option we have is to ask them how long have they been with the employer. If it's hopefully just maybe the past year or two, the easiest way we can get that information is to get their W-2. Take a look at the box 12. The code D or the code E is going to show their contributions to the retirement account. So that would be how much they've actually contributed to the plan. So we simply add those together. That would be their plan payments that the employees made. That comes back to them tax-free. So if the employee had taken a $1,500 distribution from the employer retirement account, but they have put in $1,000 into that account, only $500 is going to be taxable for state and local purposes. The first $1,000 is going to come back tax-free. Okay, so the question, restricted stock units and ISOs out of scope for VITA. They would be, unless you're going to be reported on the 1040, on the W-2 itself. So ISOs, we fortunately don't see a whole lot of those anymore. We see a lot more non-qualified stock options, but restricted stock units are going to be a little bit more involved going through the calculations, unless you're going to be reported on a W-2. That would be another calculation. You typically see a code on the W-2 to include those. But most likely, if people are getting stock options, restricted stock units, are probably going to be above the income threshold for VITA. So we're probably not going to see those coming through. But if you have questions or a personal return, we can still do friends and family through VITA as well. It just cannot go through the traditional VITA program. Now, we mentioned that there are typically going to be penalties if there's an early withdrawal. Now, there are a couple that can have some exceptions. And I mentioned a code 1 is going to be that the provider does not know any of the exceptions. A code 2 would be that they're actually aware that something had happened, that there was money taken out of the account for a non-penalty purpose. Now, that could be something that they may have taken money out for, maybe a birth of a child, but some other ones that may have occurred. We may see that you have a distribution from an IRA to convert to a Roth IRA. So a very popular planning technique this year, particularly with the stock market going down in value here, is to convert your IRA assets to an IRA, to a Roth IRA. And what happens when you convert those, the balance becomes taxable. But the good part is, if you were thinking about doing it, now's a good time to do it when the market's down, the values are down. You can actually convert that to a Roth IRA at a much lower value. You're going to pay tax on a much lower dollar threshold. Now, while that's going to be taxable, that's not subject to an early withdrawal penalty. So if the monies were used to convert to a Roth IRA, we're in good shape. The other option we have would be if you rolled accounts over. Now, typically, a direct rollover is the best way to go. That's going to go from plan sponsor to plan sponsor. There's no taxability at all. It works out very nicely. However, you may have an individual, and I've had this happen with clients that say, I'm going to take money out of my retirement account. I need a little bit of cash real quick. Maybe I have to settle on a property. And once I'm done, I'm going to put the money back into my retirement account. That is fine. You can do that. Not highly recommended, because you only have 60 actual days. So 60 days from the distribution, that money has to be back into an account for it to qualify as a rollover. That's 60 consecutive days, not bank days, not working days. It's 60 days. So if that happens, you can actually just indicate rollover in tax layer. Again, we probably want to be sure the client is giving us appropriate information to say that, yes, they actually have put the money back in. Probably a good time to remind them that they need to be responsible for all of their documentation. If there was a payment of IRS levies, if somehow the IRS had to invade a retirement account to go ahead and pull money out that the taxpayer owes, that would also be taxable, but not subject to penalty. As I mentioned before about that code 4, that would come into play as well. Early withdrawal under 59.5, but not subject to penalty. If there is also a total and permanent disability of a participant or IRA owner, that could be a penalty exception. We may need to file the Form 5329 to document that. So a question had been raised before about how do we prove disability or total or permanent disability? We're going to go ahead and take the taxpayer's word on whether or not they have a condition that would qualify for total and permanent disability. So I'd asked before if there were any medical practitioners, and ironically this morning we actually did have a retired physician that was there. But typically we're not going to do medical exams. We're not going to go ahead and do diagnostic tests at our site to see whether or not someone's totally and permanently disabled. If they are in a condition that they are qualifying as permanently and totally disabled, we're going to take their word for it and determine whether or not they meet some of the other benefits. Now, predominantly what we have for the benefits of permanently and totally disabled could be an individual qualifies for a dependent as another taxpayer. We could have some issues that they might have some additional opportunities for medical expenses, but usually we won't see a whole lot of activity there. But if they and if they do have a total and permanent disability for purposes of the PA rent rebate, and we'll talk about week 4, we do need a certification from a physician to say that they are totally and permanently disabled. So that's one exception where we do need paperwork to go ahead and file with the return for the first time. So typically the 1099-R will indicate whether they know if there are any exceptions to penalties. If they do not know, it's just going to be a code 1. We can go ahead within tax layer and override that. And I hate using the word override. It's really just correcting that. by saying we can tell the IRS there are some penalty exceptions that could apply. And we can actually do that. As I mentioned, the Form 5329 does not automatically populate. TaxSlayer automatically assumes the 10% is going to apply unless we tell it, nope, we actually have a valid reason why the 10% should not apply. So here on the slide, we actually tell you what to do in TaxSlayer. You can go into other taxes, tax on early distribution. We're going to say what amount should not be subject to penalty under Part 1. And then we're going to select a reason from the drop-down menu and let them know why it should not be subject to penalty. Still going to be taxable, but not subject to penalty. So as we take a look here, what are some possible exceptions we may have to the penalty? We're going to find this on H3 of your 4012. One of the things we take a look at is there are a couple of areas that we can actually utilize that will eliminate the penalty, as I mentioned, or eliminate or reduce, but not get rid of the taxability of the distribution. That will always be taxable. And in these circumstances, we're just taking a look at the penalty part. Now, generally what I recommend is when you have someone who's taken an early distribution from a retirement account, always ask, or at least I always ask, what was the purpose behind the distribution? Why did you take money out of your account? And they'll usually volunteer a reason. Well, we had to take money out because we had to pay for health insurance, or we had a new child. We had to take money out. If they say something along those lines, that's fine. Now we can take a look a little bit deeper. If they say I took money out because my employer told me I could take money out for free and I didn't have to pay taxes on it. Okay, well, that's not true. And it's actually not a valid reason to take money out penalty free. We do have a number of codes that we can use. My suggestion is we don't just start going through and asking them whether or not these apply, because it may just lead them to an answer that we don't necessarily agree with. We don't want to try and lead them down a road that won't be substantiated. So there are a couple codes. A code 05 would be if you're taking money out of your retirement account because you have qualified unreimbursed medical expenses paid during the year that exceeds 7.5% of adjusted gross income. That's going to be a lot of medical expense. If you're taking it out of your retirement account to help cover those costs and it's over the 7.5%, and we'll talk about what that magic 7.5% means next week when we talk about itemized deduction. But if you have significant medical costs and you're taking money out of your 401k or your retirement account, you can get out of the penalty, but not out of the tax on the distribution. Now, the next three are actually only applicable for IRA distribution. So when we take a look at the 1099-R, that box next to box 7 has to be checked as yes. It has to be an X in there for it to be an IRA. You can take it out if you have health insurance for unemployed individuals. Code 8 might be a little bit more popular. That's if you're taking money out of an IRA to pay for higher education expenses. That can be anything from fees, tuition, books, room and board, related equipment. You cannot take any money out that is going to be basically offset by scholarship. But other than that, it's a fairly broad category. Again, it's only going to get rid of the penalty, not the actual tax on the distribution. Also for IRAs, you can take money up to $10,000 for the purchase of a home. Another one that could actually be a little bit more applicable, however, is code 12. This is relatively new in our tax code. So this gives you the opportunity to take out to $5,000 from your account for the birth or adoption of a child. Now, it's still going to be taxable, but this is going to eliminate the penalty. So if someone says, I took money out of my account and I happen to have a new kid, well, this could give you an opportunity to maybe take a look and see, can we qualify for penalty relief by using the code 12 for the exception of the penalty for early withdrawal. So that one might be the most applicable one I think we're going to see on that exception form, but just want to show you what those look like. One last change we have within the retirement account. For those of you who have been preparing returns for a little while back in 2020 during the start of the pandemic, the government had a change in the distribution rule. So if you were impacted by COVID, if you had COVID, family members had COVID, there was some sort of income uncertainty, and you took money out of your retirement account, the government for that year had waived the penalties as long as you took up to $100,000. And they also allowed you to spread the inclusion of that distribution income over a 3-year period. So the last year that we have for that is 2022. So in 2020, you can take the money out. You could elect to bring it back in income over 2020, 2021, and 2022, which means that this would be the final year. The only reason we'd have that is if we've seen it in the prior 2 years. We're probably not going to see that occur for most people within VITA. If it does happen, we'll have the Form 8915-F to report these qualified coronavirus distributions. All right, we're kind of moving right along here. Taking a look at our next area, which would be our Social Security and railroad benefits. So for those of you who have clients, or if you yourself are a retired railroad worker, we may see that we have railroad retirement benefits. That's going to be on the form RRB 1099. For those of you who haven't quite picked up on this yet, people in the accounting world, people in the tax world are not overly creative. So how are we coming up with these form numbers? Well, the RRB stands for Railroad Retirement Benefits. The RRB 1099 is what we call a Tier 1 benefit. It's called the blue form. That's going to be exactly like entering information for the SSA 1099. So what you would do is you can either go into that section one of two ways. So I have that guide here for you. You can go to Federal Section Income under the heading that says 1099R, RRB 1099, RRB 1099R, SSA-1099. Then go under Social Security Benefits / RRB 1099. Or if you prefer, just type in SSA in the search bar in the top left corner of your tax Slayer program. Great way to know how to enter any of these forms. You can enter that with W-2, 1099 INT. Just type that information, the keyword in the search bar, and that's automatically going to take you to the entry. So the RRB 1099, what we call the blue form, is actually going to go directly like it looks like Social Security. For the RRB Tier 2, which we call the green form, it's actually an RRB 1099-R. That goes into a slightly different input area. Again, you're going to go in the main heading. It's just going to have the difference between whether you go into Social Security or the RRB 1099-R, or just type in RR as a keyword, and it'll automatically take you to the input section. All right, how are we feeling on the retirement side of things? Any questions arising at this point before we head into capital gains, and then we'll head into business income, and then follow up in a little bit here with just a little bit more of other income activity. Okay, so heading into capital gains and losses. So what we're looking at here is we have a lot of transaction activity that is going to be within scope for VITA. That's going to include sales of stock, sales of mutual funds, sales of a principal residence type of anything that you can kind of take a look at in investment. So the question had arisen a little bit earlier today, can we handle cryptocurrency transactions within VITA? And the question is, as long as they are reported within a investment account. So if you have, say, a Robinhood account and you are owning cryptocurrency and it's all being reported, that's going to be treated just like a stock transaction. So that would be within scope for VITA. If you have a client who is actively mining or managing their cryptocurrency, if they're using virtual currency to pay for transactions, if they're getting paid for their services in cryptocurrency, if they're using it to pay for services or products, that is outside the scope of VITA. So we cannot handle significant virtual currency transactions. If you're looking at me and you have no idea what cryptocurrency is, that's fine. We're probably not going to see that coming into VITA. So we don't really need to worry too much about it. But if someone says, I have invested in Bitcoin because my neighbor, my grandchild, or I saw it on the internet that I should be in Bitcoin, I invested in it. Most likely, if they're coming into VITA, they do not do incredibly well in the crypto market, because otherwise it'd be well over the 62,000. But if they have it in their mutual funds, or if they have it in their stock portfolio, we can certainly treat that. So a couple of things we want to take a look at for capital gains and losses, a couple of things that we actually need. Simply sales price. So we have to know how much it sold for. Not really a big deal, because we're probably going to get that reported to us in one of these other 1099 forms. We do need to know the adjusted basis of the asset. So that's typically going to be how much the individual had paid for it, or maybe a couple of their adjustments. I'll go over a little bit more information in just a second. We need to determine whether that's going to be a short-term or long-term holding period. What we're looking at here is we're going to see short-term is anything held for 1 year or less. Long-term is anything held for 1 day and 1 year, or basically 1 year plus a day. Benefit there, the long-term holding period, again, has a special tax rate, which could be as low as 0%. Other thing we may want to just double check on would be any capital loss carryovers. Now, VITA, if you have been here before, it should carry over any capital loss carryovers. If they are brand new to VITA, we may want to double check their prior year return to see if there's anything reported on the Schedule D. Schedule D is where all of your capital loss activity will be summarized. The Schedule D will let us know if there are any capital loss carryovers for the current year. With the capital loss carryover, you're able to use up to $3,000 in excess losses each year against ordinary income. So if you have a $10,000 loss in 2021, you can take $3,000 of that loss in that year. The next year, you have $7,000 of loss carryover, which can be used to offset capital gains. Or if you don't have any capital gains, we can use another $3,000 in the current year, and the remaining amount, the $4,000, will carry over to the following. That information, if we've already been doing it within TaxSlayer, will automatically carry over. As I said, brand new return, just double check that Schedule D from the prior year and see if we have any other issues. So taking a look at our capital losses, where are those going to be coming from? So typically they're going to be coming off of our 1099 series again. 1099B would be coming in for purposes of stock and securities, our mutual funds, that type of thing, typically coming in off a brokerage statement. 1099S is designed for real estate. Now, we probably shouldn't see 1099Ss if they're for principal residence. If the settlement agent knows it's for a principal residence, they should not issue a 1099S. If they do, we're going to have to report that transaction on the return, and I'll talk a little bit more about sale of a principal residence in just a little bit. Now, what we're going to take a look at is we need to understand the 1099B will typically show a number of things. The date the transaction occurred, so we need that date, the sale date. It's going to show the sale price, and hopefully it's going to show the cost basis of the asset. So what we can do if we get one of these large basis schedules coming from a broker account, we don't enter all the transactions. If they're summarized, we can actually go through and just enter the summary data. So typically what we'll probably see, there might be a short term, might be a long term. We want to keep short and long term separate, obviously. There may be some codes associated with it, which we call covered or non-covered sales. Just basically means, was the basis reported to the IRS? If it was, we're in great shape because now the government knows the sales price, they know what the basis was, so we're in pretty good shape. We can summarize that activity. Now, it might be a code B that we'll see on those forms that say it's a non-covered transaction and the basis is not reported to the IRS. We still need to report some basis to the IRS. And basis is going to be however much we paid for the asset. So hopefully we have that number. If we don't have the number, we cannot make it up for the client. The client's going to have to give us something. If they can't come up with something, the government has a default number that they can use if we so choose. That number happens to be 0. That number is not a great number. The government's going to say, well, if you can't come up with a basis, there is no basis. Well, that probably doesn't make sense because basis is actually how much did the asset cost us? Well, pretty much anything we had to pay for it somehow. Either we paid for it, which would be our original cost, or maybe we inherited that asset. If we inherited the asset, then the asset's going to have a basis as of the date of death value of the individual. If someone gave us the asset as a gift, we get their basis carrying over. So if we don't have if we get a transaction that says basis unknown, the first step we have to do, and what I usually recommend, is take a look at that packet we get from the broker. Sometimes in the back, they'll actually have the basis reported there. So even though it might not be on the front page or the front couple pages because they're not required to report it, they may still have that basis information. That's our first step. See if there's something there that shows basis. If there's nothing in the documents that shows basis activity, we're going to have to send that individual back to either their broker or someone else that can help give us the basis number or default and put a 0 in. Again, if they have just long-term gain transactions, it may not have an impact on their taxes, but certainly we can't create a number for them. One of the other things we're going to take a look at is just understanding that basis is going to be the original cost plus any other adjustments, things like commissions or fees. When we take a look at property, it's going to be things like improvements that they've made. Again, we cannot go ahead and create a number for someone. So if they say, I've sold a cabin in the woods, okay, great. I see that you sold it for $80,000. How much did you pay for it? Well, I don't remember. We bought it in 1950. I inherited it from my family. I know we put a couple things into it. Can we just make up a number? No, we cannot make up a number. We need to come up with something there for that process. Okay. Okay. So question coming in about the basis schedule. If you inherit, you get stepped up in basis. But if you were gifted shares, you don't you acquire the original cost? Yes, that is correct. So if you are inheriting property, that you will get the basis as of the date of death of the decedent. So whatever the fair value was at the date of their death, that is your new cost basis. If someone gifts you some sort of asset, stock or whatever else, you're going to inherit, you're going to basically take over their basis in the asset. So if they pass away, you get a step up in basis, as we kind of call it in the accounting world, where it becomes the fair value as of the date of death. If you are gifted the asset, it's going to be a carryover from their basis piece. But just to reiterate, for the basis, we need them to come up with a number. If not provided to us, we cannot create one. So just as a reminder, again, long-term capital gain property is going to be taxed at a lower rate than short-term capital gains. It's always going to be a lower rate than your ordinary income tax. Just one more thing I want to point out about sale activity. So the sale of a main home typically will not be reported on the Schedule D or the 8949 unless one of the following conditions happens. If they do not meet the home exclusion rules, or if for some reason they received a 1099-S. So one of the things we have to take a look at is, what is the exclusion rule for the sale of a main home? So what we're looking at is, we see it's called sale of a principal residence, which means it has to be the main home of the taxpayer. Fortunately, people coming into VITA, I'm pretty sure we're looking at just one home. I've yet to see someone coming into VITA where they say, well, which address would you like to use? Would you like to use my Lancaster address? Do you want to use my beach address, my mountain address, my Aspen home, my one in the Caribbean? Which home do you want to use for the address? Usually within VITA, we don't have that issue. It's going to be one home. So it has to be their principal residence. They also have to have a meet of 2 of 5 year test. So they have to have owned the home for at least 2 of the last 5 years and lived in the home at least for 2 of the last 5 years. Now, what's unique, they don't have to be consecutive timeframes. Government loves to put this on the exams and say, well, what happens if the taxpayer rented a home for the last 3 years and then decided they wanted to buy it, but after they bought it, they moved out of the house? Well, technically, they're going to still meet the 2 of 5 year rule, because they've lived in the home for the past 3 of the 5 years, and they own the home for 2 of the 5 years. So it doesn't have to be consecutively. We're probably not going to have that issue here. Now, what we're going to take a look at, though, is the exclusion is $250,000 per taxpayer. What's great about this process, if we know that they've lived in the home for 2 of the 5 years, they've owned the home for 2 of the 5 years, and they sold their home for $240,000, guess what? There's no tax at all on the home. $250,000 exclusion. If they bought their home for $100,000 and they sell it for $340,000, again, no tax on the home, because when we take a look, we'll subtract the 340 with the $100 of cost. We're under the $250, no problem. If they are married filing jointly, it goes up to $500,000. So we should be in pretty good shape for most people, as long as they meet the sale of principal residence definition. So how do we determine selling price? Is going to be the total amount that the seller received for the home. We do get to deduct things like our selling expenses, our commissions, our transfer tax fees, our any of our legal fees, that type of thing. Basis is what they paid for their home plus any additions and improvements. If you talk to people, they're probably going to say, yes, I know we put money into the home. Again, we can't tell them how much they put in. They're going to have to give us some number that seems that we can rely upon. All right. Any questions on gain activity or sale of residence or property? All right. We're going to move into our final little sections here and talk a little bit about business income. So most of the things we've talked about today are predominantly coming off of some sort of form that is given us by the taxpayer. Again, the government's also going to get a copy of that form, so it's going to be important that we make sure that we actually report all the activity that we see. One thing that might be a little bit different would be business income. So business income is going to be reported by the taxpayer. That's considered self-employment income. There's a separate schedule we're going to use. It's called a Schedule C. For those of you who have prepared returns in the past, there is no longer a Schedule C-EZ. It's just going to be the Schedule C. Also, for the past couple of years, we've had this automatic qualified business income deduction. This will not show up on the Schedule C, but it does actually appear on the Form 1040. So it is an automatic 20% deduction basically giving you a brand new tax deduction for any of your self-employment earnings. Very basic example. Let's just assume that a taxpayer has $10,000 of earnings from self-employment. They're going to go through the calculation. The Form 8995 is automatically going to do that for the taxpayer. If it's 20%, they may end up with a $2,000 tax deduction. So it's kind of a way in which they're encouraging people to be in business. Now, we may not see a lot of this. Is really not designed within the VITA program for someone who is fully self-employed to come in for VITA to have us prepare their returns for a variety of reasons. One is they need to provide us all the information. We can't go ahead and start adding up their income or coming up with a list of their expenses or doing a couple of those things. We're not going to get their bank accounts and help them create a financial statement. They need to do that on their own. So we can't really do any bookkeeping for them. We have a couple other rules for VITA. So they cannot have more than $10,000 in business expenses, meaning it cannot be kind of a robust business that they're in full time. They can't have a loss from the business. And the reason why is because business losses have a little bit more area of subjectivity to them. Government understands that people may not make money in a business, but we cannot have a deductible loss. There's a couple issues we run into about offsetting other income or having hobby loss rules. So just a little bit more complex. Obviously, we cannot have employees. We're not going to be running payroll here at VITA. They cannot have returns and allowances or inventory. So they can't be holding on to inventory. They can't be buying and selling things. Now, if you have a client that has a little bit of activity, maybe they're doing some Etsy work, that's traditionally kind of made as needed. We're not really seeing a whole lot of people storing up inventory. So we can't have any inventory within our VITA program. Also, farming income. We cannot handle farm activity. I know we're going to be putting a Quarryville site in here. I know it'll be very tempting for us to go ahead and say, let's do some returns for people within the farming community. A little bit more complexity when it comes to farming activity. So usually we'll have things like all kinds of different activity. We're going to have to talk about depreciation for chicken and horses and things like that. I'm happy to do that, but we just don't have the capacity in VITA to handle the farm activity. Depreciation of equipment. So we cannot actually handle depreciation of furniture and equipment. Again, there are a couple tax rules involved that will make it a little bit more complex. So the IRS does not allow us to handle depreciation, which also includes home office rules. So we cannot do a home office, and we also cannot do a self-employed health insurance deduction. So one of the things we're going to take a look at for the business is predominantly going to be coming in from people who are probably looking at an additional income, which we call kind of the side hustle or gig economy. People are looking to do a little bit of extra money. It could be things like driving for Lyft or Uber. It could be things like maybe helping out as an independent contractor with doing some siding or moving. It could be helping out at a farm stand or a local shop for a little bit, but not getting paid as an employee. Couple of things we need to know is just the principal business activity, and then also what's called a business code. If we can't define what it is, we can actually use a code. It's going to be a list within VITA itself or the tax layer program, and you can pick whatever the closest occupation is to that. So that could be simply, if we don't know what it is, we can put other not described. I believe that's a code 99999. If there is something that's a little bit more appropriate, we can certainly put that in as well. Now, how do we determine what business income we have? Well, one way we could get that would be if we have a Form 1099 NEC. The NEC stands for non-employee compensation. So that's going to be reported if individuals are working for a company or doing business for a company, and the company is going to report that to them. It's going to have their social security number on. The government's going to know that they've been paid. So we're going to have to report that on the tax return itself. We have in the past seen the Form 1099 miscellaneous. We've been using the 1099 NEC for the past couple of years. What we're going to take a look at is the MIS is not really, the MISC is not going to really be used except for rental activity. We don't do rental activity within VITA. We might have a little bit of other income or prizes and awards, but probably should not see 1099 miscellaneous coming in. If you do get someone dropping off a 1099 NEC, and again, that could be coming because you're getting one from Lyft or Uber, maybe they do some light cleaning for offices or things like that on the side, and they get a 1099 NEC, you can actually enter that directly in a tax layer. Again, under the federal section income Form 1099 NEC, or just type in the word SC, and we can actually link that to a Schedule C. So you can actually input the 1099 NEC to make sure everything's reported. And there's a great screenshot on D19 of your 4012 that'll show you how that'll work. So business income could be coming in off the NEC. It could be coming in off a 1099K. I believe most of our Lyft or Uber drivers are probably going to get the 1099 NEC and not the 1099K. The 1099K is actually for credit card processors or electronic bank transfers. So just to watch, the government's actually requiring that we see a lot more disclosure of things like PayPal, of Venmo, where these payments are going, and we may just see a little bit more reporting of that activity. So they can also have cash. They can have cash coming in. Just to be aware, the IRS isn't necessarily a huge fan of cash basis small businesses, but that doesn't mean we don't have to report it. If someone comes in and they say that I watch some children after school for the parents in the neighborhood, they pay me cash, we can absolutely, and we should, report that on the income tax return. So we'll talk a little bit about some expenses. I'll kind of mention a couple red flags that we may have. Fortunately, I don't think we've seen this very often within VITA, people trying to take advantage of the business tax rules. So again, we have some limitations with what kind of deductions we can take. We can take things like advertising. So advertising would be things like printing up business cards or T-shirts, or if you want to spend money on Facebook ads or things like that, that would be fine. Advertising does not include going ahead and getting one of those little magnetic signs and putting on the side of your car and driving all over town and saying, every time I drive somewhere, I get a advertising expense. That does not work. We've seen these before. We've had people who have gotten emails from former commissioners of the IRS that say this is fine. Usually we don't want to take tax advice from the internet, from Reddit. That's probably not the best spot to do it. Probably not daytime talk shows do we want to get that activity. So we just want to be sure that we're taking a look and seeing what type of expenses are going to be deductible. Advertising, certainly one. Car and truck expenses based on standard mileage rates. Again, if we have a Lyft or Uber driver, they should be getting a mileage report of how far they're driving. That's going to be deductible using a standard mileage rate. There's also a chart within your 4012 that'll show you how we can calculate business miles. Again, we cannot come up with that for the client. They are supposed to contemporaneously, meaning at the time that they're driving, keep track of their business miles. Commuting costs do not count, but as they're traveling between sites, maybe they have no standard location, so their home's considered their office, so all that would be considered business travel. We just have to have them give us a mileage report. If they have to pay fees for credit cards, if they have to pay insurance, if they have interest costs for their business, that could work. Generally, we probably won't see legal and professional services, because if they're going that route, they're probably staying outside of VITA for their tax prep, but who knows? Office expense, that can include things like office paper, office pens. It does not include an office and home. They can pay for things like rent or lease of vehicles, machinery, and equipment. If they have to repair the machinery and equipment, that's fine. What we're looking at, however, is we're probably in a situation where we may have some people who might do things like house painting on the side. And maybe they're going to rent things like scaffolding, or maybe they're going to have a couple minor supplies like drop cloths and things like that. That's probably okay. We're probably not going to have professional landscapers or snow removal people, because those are going to be more heavy machinery and equipment, which would probably entail depreciation. So again, we probably won't see those. We may see some travel and some meals and utilities. Just a caution with the utilities. The IRS does not like taking a home phone line, because they feel that the first line of a home is always for personal use. Again, people may be looking and saying, what is a home phone? I've not seen one. We all have cell phones. If you try and deduct a cell phone and you have a family plan, please make sure they are not trying to write off a family plan that includes 8 different lines of people. We have to be sure that the business expense is going to be related to the business. So if you have to allocate, you say we have a $200 a month plan and we have 5 people on the plan. Okay, maybe $40 would be an appropriate amount to take for a business line, as long as it's predominantly used for business. So where would that predominantly be used? Maybe if we're running Lyft or Uber and we have to have the phone available, so we're running the apps and making sure we're contacted. If we have a business and that's the only way people can contact us, that would have more of an opportunity for deduction. So just want to mention a couple things. When we talk about these expenses, again, we cannot create these numbers. We have to have the taxpayer tell us what they had in expenses. We have to remind them that the expenses must be substantiated by the taxpayer. If the IRS is going to come audit, they're not going to come audit VITA. They're going to come audit the taxpayer. So the taxpayer is going to have to make sure that they have adequate records for those purposes. I've unfortunately just recently gone through an audit with a client that I had picked up. They're a bit of an issue because the IRS was expecting their income and expenses to be a little bit different because they were looking at that business code that was used on the return. Went through that audit process. We had a brand new auditor, and we literally went through every line of expenses and every receipt they had. Not a fun process. But again, when you have that substantiation, it's going to be the burden of the taxpayer to prove those and not on us. Again, we probably shouldn't see many red flags here within VITA. Sometimes when you take a look at your certification exam, they may just have some questions about ethics. We haven't had any situations that I'm aware of within the VITA program since I've been involved, and I've been here. I'm just trying to figure out how long that's been. Feels like a couple of decades now, but I don't think it's been quite that long. But we haven't had many issues. But the IRS is aware that people may try and report cash businesses to try and qualify for things like the earned income credit. I don't think we've seen that happen here. Another thing to be aware of is rounded numbers, where someone comes in and says, okay, how'd you do in the business? Well, 20,000 of income, 10,000 of office supplies, 20,000 miles. Those all sound pretty much like made up numbers. Now, it's just something that we kind of get in our heads that we don't really like to see numbers that appear to be made up. And even in my practice, if I see someone coming in and they say I have $20,000 of income and we add it up and lo and behold, it is actually 20,000. I still feel compelled to put $20,001 down just because it looks odd to see 20,000 as a round number. But if that's what the number is, that's fine. Just round numbers have a tendency to be a little bit more suspicious for the IRS. One of the other things we take a look at is probably we'll see a little bit more on the Uber drivers. I double checked this morning with our class, and we see the majority of people coming in for our activity with self-employment are going to be from Ubers or Lyft drivers. Question coming in about the meals. Perfect. Okay, I did kind of skip over that kind of quickly. So the meals have an interesting limitation. So the government feels that eating is kind of a basic human necessity. You have to eat to be able to survive. So typically meals are only deductible by 50%. So a meal has to be engaged for the process of meeting with a client or potential client or have some business connection with it. A meal is not just that I'm hungry, I'm going to grab lunch, I'm going to write off this business meal. There has to be some business connection with it. For 2021 and 2020, if you had a meal at a restaurant or from a restaurant, meaning that if you had a meal at a restaurant or had it delivered by a restaurant, you get 100% deduction of that meal. And I believe VITA has a spot, or TaxSlayer has a spot to put meals from a restaurant at 100%. If not, you put them in as a meal as a 50% limitation. But again, they have to have a business connection. It can't just be, I'm working through lunch, so I'm going to order food out. That's not a business expense. There has to be some sort of connection with that. So great question about the meals. Uber drivers, Lyft drivers, people that might have driving services, typically what we're going to see, they are considered independent contractors for tax purposes. So they are not employees. They're not going to get a W-2. As a reminder, when we talked about who has to file a return last week, anyone who has more than $400 of net earnings has to file a Form 1040 because we may have some Social Security implications. So just bear in mind, typically when we have drivers or independent contractors, they are most likely going to have income. So income is going to be subject to income tax for both federal, state, and also local purposes. But they also are going to be responsible for Social Security and Medicare taxes. So if we have someone who is an independent contractor, most likely they're going to have to pay money into the government each year. So it is kind of what it is. If they're going to earn money, there is no one other than themselves that has to pay money to the government. So they don't have anyone withholding. They might be able to offset some of that activity, particularly on the federal side, with maybe some of the credits we'll talk about next week. But predominantly, we're going to be looking at people who might have to owe money to the government. So typically, when we have an Uber or Lyft driver, their income is going to be reported to them on a 1099 NEC, as we mentioned. that non-employee compensation form, potentially on the 1099K, but most of them have been coming through on the 1099 NEC. And again, they'll flow through to the Schedule C. Typical expenses for these drivers are going to be their car and truck expenses based on their mileage rates, any of the credit card service fees they're paying, any commission they may have. If they have to get additional insurance, typically people may want to take out a additional accident rider policy or maybe a umbrella policy that can qualify. Office expenses, we should see a whole lot of these. Lyft and Uber drivers do not go ahead and print out a receipt for you. They don't send you any type of end of year thank you letter. So shouldn't see a whole lot of office expenses. But if they have some, where we're probably going to see a little bit more are going to be things like supplies. So if you have a car driving service, you're probably going to have things like cleaning supplies, wipes, maybe small bottles of water you hand out to passengers. If you have a great driver, maybe they're going to hand out little Minster gum for you. Who knows, a little Werther's Originals, another shameless plug going in there. Hopefully a little kickback from Werther's to VITA here for mentioning their name. But we'll see if we get kicked off YouTube for that. We'll see. Also utilities. So the business part of the cell phone, again, you have to use the app to drive. So if you are using a cell phone, you do have the ability to write that off. In most cases, the client's Uber or Lyft page will have a list of everything that they're aware of. So have them pull in their phone, look up the information. Often we can get most of the detail directly off of that. All right, questions on self-employment activity at all? So again, depending on what sites you're at, you may not see any of these, but just want to be sure you're well prepared, not only for if it may come in, and if you do, certainly run that by a site coordinator or someone else who has some experience. Usually these might have a little bit more involvement. Also just want to point that out. This is also, I believe, a concept for our advanced certification. So if you're interested in going to the advanced certification, it's not really that much more difficult for the testing aspect than our regular one. It also gives you the full ability to prepare and or basically do a quality review of any return that comes through our VITA program. So highly encourage you, if you're interested, to take the advanced certification. Last couple pieces we have are gambling winnings and other income. So I'll talk a little bit about gambling winning, then we'll finish off with some debt forgiveness here. So gambling winnings are reported on a Form W-2G. So I mentioned 1099s, 1098s, W-2s, all are going to be reported to the government, so we have to go ahead and do that as well. So we have to report gambling winnings. Those are typically coming off of anything from here in Pennsylvania. It can be casino winnings, it could be horse racing, it could be lottery winnings. So based on the fact that all of you are here, I'm assuming no one was in California and bought the $2 billion Powerball ticket for the fact that you're still hanging out here and volunteering. If you did win the $2 billion, hey, I appreciate you are still coming out here and volunteering. That's fantastic. But if we have gambling winnings, we have to report those on the return. People often ask, well, what if I have gambling losses? Well, you can actually deduct those only to the extent that you have gambling winnings. And the unfortunate part, they have to be reported on our Schedule A as an itemized deduction. So if the taxpayer does not have sufficient deductions to itemize, then you really don't get a benefit for the losses. And we'll talk a lot more about our itemized deductions next week when we talk about deductions and credits. But I do want to just kind of give you an example of individuals that I worked with in the VITA program before. So starting back in the pandemic, when a lot of people were working from home or had reduced hours or in between jobs, had a couple, they were actually not married, but they were engaged, and the one of the taxpayers really got into the online gaming apps and decided, while we're sitting at home, we don't really have a whole lot else to do, I'll just start playing these casino games, and had done very well. And would play for a bit and then all of a sudden win one of these big jackpots and then keep playing and then win another jackpot. So taking a look back, a little over $90,000 of gambling winnings she had for the year, all reported in the W-2G, which wouldn't have been a bad thing if she had actually cashed out while she was winning. But what she ended up doing, she kept gambling those monies and lost it all. So it didn't have anything to actually report at the end of the year in terms of take home. Well, despite the fact that she was up that big and then lost it all, probably not the best economic situation. But what kind of silver lining do we have? Well, even though she has to pick up all of that $90-some thousand of income from the W-2G, we're also able to take all of her gambling losses. And because they're so significant, they showed up on the Schedule A as an itemized deduction, which effectively offset her gambling winnings. So we got to the point where she actually did not have a tax consequence from her gambling. Now, her fiance, on the other hand, he also had played some of the games, but he decided to get out a little bit early. But he had fallen in the same type of trap where you play for a little bit, you win a little, and then all of a sudden, if you stop playing, you get an email or a text to say, hey, come back. If you come back today, we'll give you a couple extra bonus spins. Or if you put more money in, I'll give you a credit. And so he ended up winning as well. He was not quite as significant. I think probably $8,000. Again, not bad money to win. But same way, he ended up losing that money at the casino as well. But here's the difference between the two of them. Her with the 90,000 plus got to write off her gambling losses, so ended up with really a net no change. He, on the other hand, had to pick up his $8,000 of winnings, but because he couldn't itemize deductions, never got a benefit for his losses. So he effectively had to pick up $8,000 of income, even though he never really got it. So hopefully we don't have those situations within our taxpayers, but just want to remind them that if they do get gambling winnings, they will get a form from the government or the casino basically showing how much they won. They need to keep track of their losses. We can take those, but they have to be an itemized deduction for those to actually work for us. A couple other things we have is other income. Typically, that's where we're going to see the Schedule 1. We may see things like jury duty pay. We may see some things like prizes and awards. I have had a couple clients that have been on Jeopardy before, so they actually get their award winnings report on 1099 miscellaneous. Fortunately, we probably won't need to worry about those here on in VITA because it's going to be a California return, and we don't handle multi-state. So if you have any questions with additional income, typically we'll see those on the D56 of the 4012. Just last thing I want to finish off with here is debt cancellation. One of the other areas we take a look at is debts can be canceled. So we're not talking about student debt relief. That actually hasn't happened yet for the 2022 year. And in addition, that is projected to be tax-free for federal and also not taxable for PA purposes. So if you have people who have questions with student loan forgiveness, we can get more information as that becomes more apparent when that's going to actually occur. But it should be tax-free for both federal and PA purposes. What we're talking about is really personal debts. So we're looking at people who may have had credit card debt. You may have seen some of the ads where people can say, I've consolidated my debt or negotiated my debt down. If they've had more than $600 of debt relief, they're going to get a Form 1099-C, which is basically for cancellation of debt. So if they have that cancellation of debt, that is actually income that's going to have to be reported on the tax return. So a couple of things that we have with debt cancellation, as long as it's personal debt, meaning that it's only credit card debt, it's not a business debt, it has to be reported on the 1099-C. It's not related to bankruptcy. There's no interest associated with it. We can actually prepare that return. Certain student loan debt forgiveness, and what we're talking about for that one in the scope is not the brand new kind of all eligibility. That would be things like people who have had qualification due to the Department of Education kind of revoking the school status for a couple of schools, or that they met qualifications due to a public service worker. Those can actually be in scope as well. The other thing that could come into play is what we call the insolvency exemption. So the insolvency exemption is where an individual has liabilities, they have debts, and part of that is canceled. But even though that they've canceled part of the debts, they still owe more money than what they have in value. So there's actually a very specific insolvency exemption to go through. That's on the D65. That technically is not within scope within VITA. However, if you're working on friends and family returns, that would be fine. We also have some opportunity to refer people out to the Mid-Penn Legal Center to go ahead and help out with some of those issues as well. So just want to point out, if we have debt cancellation, if you get a 1099-C, if they're not going through the insolvency exemption, that's just reported as other income. So that's pretty much what we have for the presentation. Looks like we have a question coming in for debt cancellation. So debt cancellation is only taxable for federal. It's not actually taxable for PA purposes, because when we talk about PA, we'll talk about that right after Thanksgiving. So give you something to look forward to. I know we'll have a class next Thursday. The week after that's Thanksgiving. We have another class, but at 5:30 on Thanksgiving Day, I think people are probably going to be way too tired. Too much turkey and pumpkin pie for us to get a whole lot in. But the week after that, we'll talk about state and local taxation issues and talk about the classes of income. So fortunately, retirement income, Social Security income, debt forgiveness is not taxable at the state level. So we don't have to worry about that. But do want to open it up in case anyone else has any questions with our information today. Hopefully, we're going to take a look at the majority of income areas that you're probably going to see within VITA. Again, this session, a little less of having to make determinations of things like filing status and dependency, but do want to kind of point out a couple of things we might be running into, not only for the season, but also to kind of get you ready for that certification exam as well. So feel free, if you have any questions, feel free to unmute or send a question in the chat, and be happy to hang around for a bit and see what kind of questions people may have. If you decide that you like to sign off in the call, be happy to see you next week, and enjoy the rest of your evening. But I will stick around for a bit if there are any additional questions.
Great training once again, sir.
Oh, well, thank you very much, Jennifer.
How long have you been teaching?
Teaching for VITA or teaching at college?
Either.
Okay, so for college, I've been a full-time professor for about 6 years. I've been doing some adjunct work for about 4 years before that. And for VITA, it goes well beyond that time frame. So
Really?
I actually had been doing VITA well before I did teaching at the collegiate level. So yeah, it's been a good opportunity, and really something I'd been doing within practice about teaching our new employees about taxation issues and getting them ready for their first returns, and then also update return information like we have here. So yeah, been going well.
Yeah, you're naturally just a really good trainer.
Oh, thank you. I appreciate that.
And why don't people think, like, you crack me up?
Well, yeah, it all depends. I like to throw a little bit of humor in there to keep things entertaining and engaging.
It freaking cracks me up.
Nice. Good. Try and keep it exciting and engaging. So other than that, it just feels like 2 hours of sitting behind a screen watching someone drone on about income issues. So yeah.
And I kept waiting, thinking, oh, you're going to have to take a break. You're going to have to take a break.
Yeah. Yeah. I try and sense how we're doing and seeing how we're feeling. This morning was a little bit different, I think, with a lot more questions and things, but usually the evening session, I can manage it a little bit differently, just kind of keep an eye on the chat rooms and seeing what's happening there. So hopefully we're able to answer the questions that people have and make sure that they are doing well.
All right, sir.
Yeah. All right. So if anyone else has any questions, we'd be happy to go ahead and answer those yet. Looks like we have a couple of people on here yet, but if not, appreciate everyone sticking around, and we will catch up with you next week.